Okay, well, good afternoon, everyone. I'm very happy to welcome Daniel Taylor, who's the co-founder and CEO of Bags, who is joining us today and giving us some great finance tips on how to accelerate your business. So without further ado, I will pass it over to Daniel.
Hey, everyone. First of all, thank you all for taking some time on this Thursday afternoon. It's a little doom and gloom in New York, but hopefully we can have some fun. And well, first of all, thank you again for the Naturally New York community for having me. Today, I'm just going to be talking a little bit about. I'll introduce myself, but then talk a little bit about how we think and how typically we talk to brands about the alternatives to venture capital and scaling your business by finding the sort of right types of alternative funding. A little bit of background on myself. I've been a founder for the last 8 years. I've been a small business owner. I've been a small business owner as well as a technology founder. Sold my technology business in 2019. We were in the advertising technology space. And then I left to start Bags with really the core mission of, how do we enable companies led by women and people of color to get both the capital, knowledge, tools, and resources to both think about how they accelerate their growth and then actually put those methods into practice. So I'm going to run through the presentation. It'll probably be, let's call it 15 minutes for the maximum, and then would love to open it up for questions. And if you have some while I'm going through it, feel free to put them into the chat as well. I'll try to touch on them while I'm talking through it, and if not, we can definitely get into it following and try to make this as much of a conversation as possible. Sweet, awesome, excited. All right, let's get this up and running. Awesome. So at Bags, we're all about helping people find manage their finances and find better money for growth. And so today we're just going to talk a little bit about how to think about growing your business with potentially alternatives to venture. Make sure. Perfect. Okay, so I typically like to start with this, which is kind of the statement that venture might not say yes to your business, but that doesn't mean you are not building an incredibly good business that can generate wealth, hire great people, and have a tremendous amount of positive impact, on your community. And we think about debt as a really, really great consideration about how you think about growth. But I think this is the misconception that we want to try to tackle so that we can reshift our mindset, specifically centered around how we think about the 3 best ways one could fund a business. So before we even get started, the thing that we typically do with every single business is have a conversation around 3 things. One, what are your goals? What are you trying to achieve, both short, medium, and long term? And that could be as simple as, hey, I spoke with a founder earlier who said, hey, listen, I'm doing $10,000 a month. I want to get to 12. That could be even bigger, in which is, hey, I want to build this brand and I want to sell it to Pepsi. But really, the first main thing that we try to understand is, and that you should try to understand, is what is your actual goal for your business? Because that'll also help determine the different types of financing capital that you should consider when thinking about that growth, right? On the venture side, that's we typically like to think about venture capital as being reserved for businesses that are trying to either drive real innovation within a capital intensive sector that has the potential to be a multi-billion-dollar business. Whereas, you might be sitting here saying, hey, I want to actually grow my business to be $20 million a year business. And that's a huge win. And so, really thinking through those goals is the first step. The second piece is financial visibility. And this is something that we find is unfortunately more frequent than we would like. Getting a core understanding of your financials is essential in planning and mapping out the next strategic growth initiatives for your business. If you don't have that financial visibility, it's very, very hard to make those decisions as to whether you should be reinvesting dollars towards one sector of your business or another, or even considering whether you should be taking on debt, looking at crowdfunding, applying grants, or trying to raise equity, right? So the big thing that we typically ask businesses to do is, get that financial visibility. And, it's one of the reasons why we recently rolled out full suite end-to-end bookkeeping and accounting, because when working with so many businesses to try to make sure that they get financed, the number one thing that prevents those dollars from hitting their doors is not having clean books and financial visibility. So that's step two. And then three, what do you need the money for? Right. It's kind of that simple, right? Like, one of the things that we often find is that, a business might knock on our door and say, hey, great, I need $3.5 million. Then we work back and we say, all right, but really, like, where are you going to be allocating those dollars, and how are you going to put them to work to potentially do what? Hopefully unlock revenue, unlock growth. If you are seeking additional dollars, those dollars should be leveraged towards growth. Why? Because the way we think about growth is revenue is actually the best way to grow your business, first and foremost. Okay, so your funding options, right? And it goes from least expensive, most expensive, top to bottom. So one, revenue is actually the best way to grow your business, right? Like, the first conversation we always have is, how can we unlock additional revenue and additional growth for your business? If there's room for optimization there, that's step one. Before we even have a conversation about debt, equity, crowdfunding, revenue is step one. Next is debt, right? And we'll talk a little bit about the least expensive versus most expensive, but for 99% of businesses, debt should be the primary consideration for how one thinks about funding their growth. And debt is an overarching, all-encompassing sort of statement, and we'll talk a little bit about the specifics in a little bit, but we sort of put debt in this sort of second category, and it should be, again, leverage towards unlocking what? Revenue. And then third is equity. We put that all the way down on our sort of capital stack ladder. And then we put sort of crowdfunding and grants. They sort of fit somewhere in the middle, which I'll touch on in a little bit towards the end of the presentation, because it's worth acknowledging. But just like any of these, specifically the debt, equity, crowdfunding, and grants category, there are pros and cons. Okay, so how do you actually make sure that those dollars are put to work, specifically if you're thinking about building a brand? And so we like to think of it in the form of a flywheel. And as mentioned, the first piece of things are centered around financial visibility and strengthening your revenue and or cash flow position. So if there are areas for optimization there, we actually think about diving in and doing that work first prior to even considering exploring different types of debt options. After you actually have strengthened your cash flow position, you actually should go out and start to think about debt, get an understanding of eligibility and what that looks like. That's a big part of what we do here at Bags, is give you that visibility and financial visibility, and then put those dollars to work by investing in growth, right? Which then should strengthen your cash flow position, right? Strengthen your revenue so that you could potentially unlock new debt opportunities and reinvest in growth. That is sort of the three-pronged flywheel that will help you effectively, think about taking steps forward in that growth. And I think the next slide is, and so I'll talk a little bit about like what this looks like in a real life example, because Haley's an incredible founder, and she's kind of lived through what we hope more brands continue to push through and drive as they think about their growth financing journey. So Haley is the founder of a swimwear line specifically targeted towards plus size women. And she was doing about $40,000 in revenue last year. She applied to VCs. She reached out to different types of online lenders and programs. But unfortunately, her problem was that actually she didn't have enough supply to meet demand. Right, there was a market inefficiency with both how much capital she had and the demand on the other side, and so she could never catch up. So she actually had an additional $120,000 worth of revenue demand that she could not meet due to lack of inventory. And we see specifically time and time again with businesses is that the thing that is limiting their growth is not actually the fact that there isn't demand for their product. It's actually that they don't have the right access to capital to unlock that growth. And so Haley came to us, on board into the platform. We gave her a core understanding of her eligibility and helped her build a funding plan that included a 3, 6, and 12-month targets that laid out the different types of financing that she should consider when thinking about growth, short, medium, and long term. The first thing that she did actually was ended up getting $14,000 worth of PO financing, purchase order financing, to unlock an additional $40,000 in potential revenue. All right. Following that, she was able to grow the first quarter of this year. She ended up 8xing her quarterly revenue from the year prior, just in the first quarter. But the real thing here was that she was taking a long-term perspective around the different types of financing options that she should consider. So we already had laid out, as soon as she hit that next revenue threshold, we unlocked an additional $350,000 of available credit and loans for her, so that she is going to end up doing this year. She broke $1 million about 3 months ago. Hopefully she's going to end up somewhere around 1.25 to 1.5. Like, that's the goal, right? Increase available credit, reinvest those dollars into your business growth, and then in the end, hit and in her case, really expand and scale your business. So following this, I'm just going to break down the different types of loans, but I'll try to run through this and then specifically talk about the ones that are most relevant towards CPG brands, because CPG businesses are unique in that they need to keep a strong pulse in their cash conversion cycle. So I'll put that in its own bucket, which I'll talk about in a sec. So just to run through it, so we've got a term loan, which is your more classical, business loan, right? You end up going through the process, you apply, typical term length is a year to 10, and you pay back that loan with interest on a month-to-month basis, right? That's usually a fixed monthly payment. Next, lines of credit. These are really good for seasonality, and essentially gives you the option of pulling down on debt capital when you need it, right? So say your business sort of operates in a curve like this throughout the year, but so you're really strong from a cash flow perspective, and December, November, December, and January, and then it starts to dip. Awesome. You need to make sure that you have the ability to sort of deal with that seasonality, and lines of credit can be a really good product for that. Equipment financing, in case you're buying any sorts of heavy equipment, invoice ARPO, which I'm going to dive into, merchant cash advances, which I'll also dive into, and venture debt, which typically is debt that is provided to venture-backed businesses, whereas your equity is collateral for different types of loan products. We often do not advise businesses to explore the venture debt route, especially if they qualify for other types of financing products, as they often tend to be pretty expensive and come with a significant amount of covenants or restrictions on both where you can use that money and how you can think about your growth. So let's talk about specifically what a CPG brand could look like and what that ideal debt stack and flywheel would look like. And that's really in this sort of inventory, invoice, AR, and line of credit space. So what we find is the cash conversion cycle, right? You take a bunch of money, you send it to your manufacturer, they put together the product, say that's a couple months, and you send it to your third-party logistics company. And then if you're in retail, you send it to a retailer, and maybe you get paid back over a 4 to 6 month period, right? Or you actually sit on that inventory and you go out and sell it, but even still, your cash is locked up, right? As soon as you send those dollars away to your manufacturer until you essentially go out and sell that product. That is your cash conversion cycle. And the way we think about it, it's about optimizing and shortening that cash conversion cycle so that you both have enough money left over to market and advertise your product, and you can deal with the other expenses of running your business, right? Including your employees, including your operating, including your finances. Getting that cash conversion cycle super tight, we find, is the real key to success when you are in the CPG space. And the products to think about when doing that are inventory financing, specifically to finance your inventory. That could be substituted with a term loan or a line of credit. That's one. Two, purchase order financing if you are going into retail, which will allow you to receive some of that cash that might be paid after 60, 90, 120 days upfront so that you can continue to reinvest in the growth of your business. And then accounts receivable financing, which is, if you have any sort of AR or accounts receivable that's pending. And then layering that in with a line of credit can be super advantageous so that you can essentially have a product flywheel for your supply chain and then a line of credit to deal with some of those marketing and advertising dollars if necessary. The one thing that I wanted to call out here was merchant cash advances. These are often sort of relabeled as products from a Shopify or a Square or another type of payment provider. We like to say fast money isn't necessarily always good money. In often cases, it's not the best type of dollar for your business. And unfortunately, the way they're structured is that, and this is the thing that, if you take away one thing when thinking about whether you should take out that loan first from a Shopify or Square, if you're at a tight crunch and you got to do it, okay, I completely understand. But they put a UCC filing on your business, which essentially disables you from receiving any other type of capital because they have a first priority lien over the entirety of your business and your assets, right? Which disables other lenders who might want to finance that purchase order or who might want to finance your inventory from being willing to play ball. So just think about that as you're considering your debt options if they are coming in the form of a merchant cash advance, when you're thinking about what types of dollars to consider for your growth. Where am I? I'm 15 minutes. All right, we got 5 left, and then we're going to throw it out for questions. Again, feel free to write some questions in the chat if you have any. I know there's a lot here, but I really want to make sure that we're covering it and fitting the needs of what you guys want to learn more about. So, big question usually comes: Am I ready for a loan? So, typically, we like to think of things if you're sort of in our lending partners. Typically have call it roughly $5,000 a month floor. There are lenders who are starting to do, and apologies, my cat's running around in the background. She doesn't have any hair, but she is very sweet. Typically $5,000 a month is your floor. That's one of the sort of first benchmarks that we encourage businesses to get to because that's when sort of your financing options start to be unlocked. The next thing is, are you profitable? It is not mandatory for you to be profitable in order to get debt financing. It helps a lot, right? And the thing to also think about is the reality that we often see is that, most founders, sub $10 million a year founders, they're reinvesting most of their capital into their business. So it's less so about, hey, did you take excess dollars home with you every single month? It's more about showing that you're operating from a cash flow positive perspective so that you can afford to make potential debt repayments. And then lastly is your personal credit score over 620. I know this is such an annoying part of this entire process. The personal credit space has been so industrialized, and that's a very, very easy thing for any type of lender to grapple onto. And so we do work with lenders who don't consider credit score, but the reality is that many sort of look for that 600 credit score floor. And if you don't have that, there's other things to consider that potentially get you over the line, whether that's, you've got a purchase order or other assets that you could potentially take over the loan against. So, magical items for loan success as mentioned, good personal credit, consistently and growing monthly revenue, positive profit margins, or at least, close to par. And then, from an existing liabilities perspective, it's okay if you currently do have, for example, personal credit and you need to get into business credit. That's a big thing that we often see with businesses. You maxed out your credit cards and now you need to get it into a business loan. That's okay, but making sure that you manage that effectively is going to be really, really key. And if you have other business loans, right, thinking about what can be refinanced. For example, you took out a loan from Shopify. There are lenders who will refinance you out of that. right? And give you the ability to pay that back at a lower monthly payment. And then that will potentially unlock new avenues for capital. Other considerations, collateral, gross margins, debt service coverage ratio. I'm not going to dive into these too specifically right now. The one thing that I will just reiterate is UCC filings are often placed by merchant cash advance providers, which are the Shopify, Squares, PayPal's, Amazon's of the world. And they can really, really hurt your ability to receive additional capital. And so we encourage businesses that are thinking about debt to not just think about it in terms of I need money today and tomorrow, but to really start to build a funding plan towards that growth that includes different milestones. And we can definitely help you think about that as you are taking those steps towards financial growth with debt. So pros and cons, it's non-dilutive, right? So the one thing that people always forget about giving money, giving equity away to a potential investor, right, is that in reality that it will be more expensive than debt products, period, right? It will over time. And so the non-dilutive element, keeping ownership, keeping your decision-making power, we think is an essential part of business growth. It doesn't mean you don't need incredible expertise around you. That always helps. But the fact that debt is non-dilutive is great. It can move fast. There is cash flexibility, and it's cheaper than equity over time. The reality on the con side is that there's a lot of predatory products out there that can be super, super expensive, and navigating that is essential, right? It's part of, honestly, it's half of what we end up doing for a lot of the businesses that we work with is considering other offers against what you need to use the money for. Because the reality is that, you can go on a line and find a bunch of different lending products, but they purposely make it difficult for you to understand the net implications of that product in your business. And the entirety of why we exist is trying to bring all that information upstream so that, you can make strong decisions. Next, personal credit is considered. It's tough, but it really is. There are things that can be done on the personal credit side to improve, to unlock business credit, but often that's part of why we love creating this pathway between getting out of personal debt into business debt, because that'll actually end up contributing to your sort of total credit on both sides if we're able to make it happen. Financial visibility is really key, and then you got to remember you got to pay it back, right? The one thing about debt, it's if you don't continue to make those payments, right, businesses, the lender potentially, either take assets away from you, but it's really, really key to, and this is why the first step to this entire process is understand what your goals are, get your financial visibility, and see whether you can actually really afford to pay that debt back, and then tap into the minimum available debt you need in order to hit that next level goal. So last two alternatives, crowdfunding and grants. So grants, I think there's, especially in today's world, there's a ton of, there are new grants that are being announced every single day. They're good on the surface, right? So it's free money, you get some attention, and by the way, it's free money, which is awesome. We love that. The hard thing about grants is that, in terms of likelihood of getting approved, the odds are unfortunately stacked against you, right? And they do take real time. And real time to do well and apply well, and still you might not be approved. And so, and the last part is sometimes they come with restrictions in regards to use of funds. But again, for us, we encourage businesses to be thinking and reallocating that time applying for a grant to be really spending your mental time thinking about revenue growth and potentially how debt could unlock revenue growth along that cycle. And then crowdfunding. So just to run through the different types. So we've got product crowdfunding, equity crowdfunding, and debt crowdfunding. Product crowdfunding is where you are pre-selling product, right? Often at some sort of a discount, right? To your customers to fund the production of said product, right? Equity is where you are giving away equity in your business, but raising from a larger group of people rather than potentially one venture capitalist or one angel investor. And then debt is debt, but also supplied from a group of people. The one thing to really, really think about from a crowdfunding perspective, and we've seen it happen on both sides, But if you are thinking about crowdfunding, come to the table with a very, very, very strong pre-built community. Crowdfunding is successful when there is a community of people that have a vested interest in your success already, right? When you do not have a community, it often results in your crowdfunding campaign not being complete. And the other reality of crowdfunding is that it doesn't matter what the platform says about how much they're going to advertise your campaign. Your full-time job will be marketing your crowdfunding campaign, right? And so when you're thinking about the opportunity cost of your time, do you have that community? Are you great at marketing? And do you want to really go through and advertise and market to your community to receive potentially those dollars and that income? Because that is what it's going to take to really make sure that you get the sizable amount you'd hope for within a crowdfunding campaign, right? And there are some providers, right? Like, from a debt crowdfunding perspective, Kiva, for example, is one. And there are a few others that are, for smaller types of loans. But typically, especially in the larger lending space, if you're looking for anything over $25,000, I wouldn't necessarily suggest that going down the debt crowdfunding space, just because there are literally hundreds, if not thousands, of lenders who've got products that they need to lend to you, that will be easier for you to get than potentially going down the debt crowdfunding route. So just to round it all up, I know I was a bit longer than 15 minutes here, but one, if you just to sort of reiterate what we do here at Bags, the entirety of why we exist is that we believe and we have proven that if businesses know more about their financing options, they will raise more money at a cheaper cost. And if we can combine that with strong financial visibility, businesses' likelihood of getting that loan will increase 2 to 3 times. And so that is what we do here at Bags. We help businesses build a funding plan towards growth, enable them with a funding coach to help consider their options, give them an understanding of what eligibility looks like, and plan their growth against different financing options over time from a network of lenders that we've deemed as both equitable and believe in our mission of empowering access to capital for underrepresented founders. And then the other big part of what we do is give you that financial visibility to really make sure that you have clarity over your own finances. And we do that through end-to-end bookkeeping and accounting, as well as our different finance tools built into our platform to make sure that you really understand as you grow what types of debt options potentially open up for you. So let me stop here. I saw there were a couple messages in the chat, and I will stop sharing my screen. So let's see.
Okay.
Yeah. So question in regards to fees Bags charge. So Bags charges a monthly subscription fee that's based off of the size of a business, right? And so and that ranges from $200 a month to actually there's a $100 a month option all the way up to I think our highest monthly on the accounting side is maybe $600 for a business that's doing a few million bucks plus. And so and we offer both monthly, quarterly, and annual pricing. A big part of why we work with businesses long term over the course of years, because the real value ROI comes in that 2-3 month window where we can work with you, get your finances to be cleaned up, apply to lenders, manage those products once you have them, and really get smart about how you continue to scale over time. We want to be that financing partner rather than just be hey, come to us when you need a loan. It's being predictive about it rather than being passive about it.
Great. Thank you, Daniel. Does anyone else have a question they would like to ask? You're welcome to unmute yourself or drop it in the chat.
Hi, this is Javed. Daniel, thank you for the very nice presentation. This is quite helpful. I really had sort of a 2-part question, and I'm curious to get your perspective on both. And the first question that I had was for some of the financing solutions that you were referring to earlier on in your presentation. Could you speak to if those financing solutions are coming with a personal guarantee that the owner is taking, or that the business owner is taking on their head? And then the second question is specifically for the Shopify's and the Stripes and the financing solutions that they're offering. What do you think the annual APR on those looks like? I recognize that they're getting sort of the first dollar out of the gate. I don't know if you've talked to your contacts who have gone through it and done some of that. I'm curious, just if you annualize that, what do those percentages typically look like?
Of course. And would you repeat your first question for me?
Yeah, the first question.
Yeah.
No problem. The first question is about personal guarantees.
Yes. Okay. Yep. Perfect.
That's
Perfect. Okay. So the answer on personal guarantees is that it really depends, right? Depends on both the current state and financials of your business, depends on the type of product you're applying to, right? So for products, for example, where there is another form of guarantee. So in the case of inventory financing, you are guaranteeing through your inventory. They're placing a lien on that inventory, which is what they sort of finance against, right? In other cases, they're financing against your cash flows. In other cases, they're financing against potential accounts receivable or other types of assets as it relates to your business. On the personal guarantee side, what we often find is that it really does depend on who the lender is, right? And your personal credit situation, right? Because, really the 620 floor, the 600 floor is less so that they are saying, hey, us and every single loan we give out is going to require a personal guarantee from you. It's more so for them to consider your, call it, credit history and worthiness, right? So that if it is below that sort of threshold, the likelihood of some form of personal guarantee, if it is for a product that is not being secured by another form of asset or another form of receivable, or incredible good cash flow stream business, they'll potentially ask for a personal guarantee, right? So it really does depend both on the business, the use case, the what is guaranteeing it from the get-go, and potentially from the type of lender that you're getting it from, whether that be a private lender or you're trying to apply for an SBA loan or something of that sort. To your other question around APR, so it's interesting. They typically, I'm sure many of you could go on Shopify or Square right now, and they'll have some sort of financial offer, right, for giving you a loan, and you'll be able to get it in your bank account next day. The reality is, yes, you will be able to get those dollars in your bank account the next day. But typically, we are seeing fees, and this is a flat fee, not interest rate, a flat fee that is plus on the floor side, 12%, right? So I think I've seen a couple, one or two that are 10, and then typically they're in the 15 to 18% range. And that is charged upfront, right? And so when you actually amortize that out in terms of interest rate, right, that ends up being in the plus 30% APR space, which is often worse than the credit card you swiped to get a coffee earlier, right? And so then the other drawback there is that their first priority on dollars that come in, because they are often point of sale providers, right? They can, every single time you swipe, there also is a condition where anywhere between 10 to 20% of every dollar you earn goes back towards repaying that loan until it is repaid in full. The good thing about that is that in a case where you've got a down month, right, the amount is much less. But in the case where you crush it, the amount ends up being significantly more. And in a business where you're operating, with somewhat tight margins, that could mean that your margin is being eaten up by those repayments during that period of time, which we often see ends up being the case in the cycle. And so typically our advice is if you are in a real financial pinch, for example, and you need to, you have some dollars coming in 4 days from now and you need to make a payment today, right? Like, and that's really secure. Great. Take out as little as you need to in order to make that payment and then immediately pay that off. And if you currently have one, start to think about exploring different refinancing options for those products yesterday, because it's for us, it's all about increasing the total amount of available credit. Available credit does not mean you have to take out that loan for your business. It means you have, just as you have with your personal credit, the ability to tap into those additional dollars when you need them for growth. And you've thought strategically about pre-vetting, pre-applying, and having them in your corner so that you can take them out when needed and when necessary. And by getting out of potentially those MCA loans, that's a really, really good way to unlock options. Have we heard of C2FO? Yes, we have. Becky, thank you for your question. And yes, we have heard of C2FO. We've worked with them a little bit. So they are in the AR space. They've got a couple products that are decent, but we always implore people, if you are exploring accounts receivable financing, apply to multiple at the same time, because often it's what we find is they usually have their own dollar threshold. So the person that'll fund your AR at 20,000 to 50,000 versus 50 to 100 versus 100 to 150 is different. And so making sure that you've got the right ones in your corner is super, super important. And then there are newer lenders who are trying to do AR in an equitable fashion. Now Corp is one that we think is incredible. But yeah, we work with a ton of others, and more than happy, Becky, to chat with and work through a few of them. All good. What else, guys?
Don't be shy.
While we're waiting for someone else to speak up, Daniel, maybe I can ask you another question. I think I was just thinking through your original response to this. I'm sure you must be talking to a lot of folks who almost have, from a sort of a brand entrepreneur perspective, an allergic reaction to personal guarantee. As I just through sort of just intuitively, I worked through in my mind, if you're a DTC business that has almost no inventory or sort of big retailers that you're working with in the initial years. So almost all of your orders are piecemeal that are coming from consumers daily. So you don't have an inventory to rely upon. And you're almost, again, have an allergic reaction to just not want to have any personal guarantee. Does it then almost make sense in some respects to go that Shopify financing solutions direction, even if it's sort of this like brutal 30% APR financing, assuming that sort of the thing that you're taking on is to, at the very least, break even at the end of the day after paying that financing cost? I was just thinking through how to scale just given
that's a really good point. So my short answer is what we often find is the decision, especially for earlier stage brands, is like, do I put my money to get more inventory, or do I put my money to get more dollars for marketing? Right. So like that's often the decision. And what we find from like, is it worth taking out a Stripe or some sort of other financing product? It's short term, it could be, but the problem becomes is that during that period of repayment, given you're both like, you end up entering this cycle, right? Where the moment you cross that now threshold, okay, so you take out that Shopify and now your business starts to really, and then you actually become credit sort of potentially credit approved or debt approved for a new product, you're already in their cycle. So it's actually really hard to almost lever out of it. And then what ends up happening is business takes on one, they pay it off, and then they're like, okay, great. They take on another and they pay it off. Especially in the early days, like in our point around reinvesting those revenues, like that margin percentage that's being repaid back, we often would suggest to reinvest that as your growth, as to how you think about your initial growth, than necessarily taking out a ton of leverage from one of these providers. And often the other problem is that typically they don't even give you the total amount you would really need to make your business get to where you really want it to go. And there are more lenders who are starting to play slightly earlier and are willing. And listen, the personal guarantee piece of it, I mean, at the end of the day, and this is, I'm sure there are an incredible group of founders on this call, we all have very different financial situations, right? And so, the big thing for us is like, hey, we are never going to get on the phone with an entrepreneur and be like, yeah, take out that personal guarantee, go, right? But it's really just making sure that you at least are equipped with the knowledge of options so that you can decide whether that's right for you or not. And because the other, it's like in some cases it could be a personal guarantee, and again, not all, but a personal guarantee, and you grow, or a Shopify loan, and that cycle ends up eating up your business, in which case like your growth, we think, ends up being super capped because of exactly the cycle that they end up putting you to. And it actually ends up being more expensive for the businesses that do well and grow fast than the businesses that repay it really by little over time, right?
Totally, very helpful. Basically, you're saying that you're signing up for payday loans, a modern day version of payday loans, basically. Correct. Signing up for, and it's going to completely cap your sort of growth strategy. Very helpful.
Exactly. No problem. Nancy.
Hey there. So great
How
presentation.
are you?
Thanks.
Thank you.
So I've actually used pretty much almost all of the options that you've laid out at one time or another to help grow my business. So my question is a little bit, so I believe in debt, and especially this time when it's really hard out there to drum up equity investment. I'm certainly not afraid of it and have used it extensively. But my question is, at some point, if you do want to either go ahead and go after some investors, or possibly sell your company, how is all of this debt looked at? Especially like for me, in addition to the options you laid out, I have an SBA EIDL loan and a couple of other things like that, right? So, I've grown, I've used it to grow effectively, but I definitely, have a heavy burden. So what's your opinion about that?
No, without a doubt. So, first of all, I think you're completely right in terms of the state of venture right now, right? Towards CPG, we've spoken to 10 different CPG VCs that say we invest in CPG on their website, just to get on their phone with them, to now them telling us they no longer invest in CPG. It's like what are we talking about here? And do I think it'll stay? Do I think it'll stay like this forever? No. Do I think that's going to be the climate for the next? I would probably call it 12 months. Yes. And so, but here's how we typically think about positioning debt within the conversation around raising venture capital. Part of the reason why venture is not as effective in the CPG space is that often, and this is what we found with a bunch of investors who've played in the space recently, is that as businesses start to grow, they end up trying to actually reverse engineer into debt when they've used all their venture money for things like inventory and marketing. Right. And so for us, we actually like to flip that equation, right? We actually think it gives you more leverage in the conversation, because those venture dollars will actually be allocated towards real R&D and investment in the core operating capacity of the business. Right. And so what you could say is, hey, I'm actually not coming to you saying you need to give me $2.5 million because I need to go fund my inventory and this retailer, is taking a while to pay me XYZ. You can say, hey, I've actually been able to manage that very, very effectively, right? And and I'm going to actually use the real capital towards activating my growth, hiring a new salesperson to close new deals, like all the other things that potentially could really contribute towards your growth. And part of the reason why we're having conversation with those VCs right now is because they're actually pushing their portcos, right, their portfolio companies down the path of debt. Because they know and they're acknowledging that the only way for them to be really considered viable investment options going forward is if they've been able to show that they have a strong propensity to scale and effectively manage debt and growth financing within their books, right? And so it's a little bit of a flip around. M&A though is in sort of another bucket, because in the sense, like the reality is even if you look at call the sort of more micro private equity space or even just the private equity space as a whole, most of these businesses are leveraged, meaning they have debt on their books, right? And so looking at the mechanics of whether it's good debt, considered bad debt, over leveraged, right? Meaning they have too much debt for them to be able to afford, is really what we think starts to matter a lot when approaching M&A. But I will say though that there is a effectively growing community of investors who are starting to buy and purchase brands in the $1.5 million to $20 million range in a way that didn't really exist prior. So I do think that there's a real opportunity there. But it's like transparency and like that's really the key. If you've got the financial visibility and you can say, hey, listen, this is what I have the ability to pay this out effectively here. Part of this deal is going to go towards either the repayment of certain products so that you can take the entirety of the business without debt, or the signing on of the business and its liabilities as part of the acquisition as well, right? So again, but from a buyer's perspective, cash flow positive. I mean, listen, that's really why someone's going to buy a business these days, right? It's hey, can they acquire it for X, invest Y, and sell it for Z or grow it to Z? And if you can create that strong case, then it's okay that there's really a good amount of debt that's helped you get to where you need to be.
Okay.
Because they'll probably end up using debt for it too. Please.
So that's very informative. Thank you. So debt, so I've been in business since 2015, and originally debt was very cheap, and it has certainly gone up and up and up. And so anything that had a variable rate attached to it is plus. So my question is, I actually did hear recently that it's possible that the Fed will start lowering rates, right? Yeah. That would make my life so much better. But my question is what do you think is going to happen? Because debt is much more expensive even than it was a year ago. And so it's hard, when you do have to start paying it back monthly or whatever, or weekly or whatever you're doing, it's a big chunk there.
It adds up. Yeah. So let's see. Okay. So the market is starting to react as if the Fed's gonna, start to cut rates. And I'm still taking the position that I think it's going to be at least another until Q2, until they do. And I think it's going to be gradual, which is not the answer that even we want, because like that's like we're like the sooner the better, because that means all the businesses over time that have those products, right, can start to either refinance and save money, or in your case, at variable rate, save money on each repayment. And so as we think about rates being high right now versus where they might be in the future. Listen, I think the reality is that momentum is really the name of the game when continuing to build out your brand and build out your business. And if you're in a situation where rate like taking on a different financial product right now can be beneficial in your business growth, and you can be really, really cognizant of the levers to make that happen, right? Like really debt ends up just being that growth engine for you. Take the product. If you're in a situation where you're like, hey, listen, I'm not sure, and I just want to continue to grow with my momentum, don't. But what I will say, some of the positive indicators that we are seeing is that the SBA is just reforming who can deploy SBA dollars, which is going to result in an additional like $360 billion that's going to flow into the market that wasn't readily available prior, which is really interesting. And those rates typically often end up being more affordable than other products. But the problem, as you've experienced, I'm sure, is that as of right now, it is a pain in the ASS, right, to get any type of SBA product.
Yes.
Right. And so, but there's let's just put it this way, pre the next election, there's going to be continue to be a large influx of capital towards small business lending. And those dollars have already been allocated. And therefore, I do think that I am hopelessly, but I am optimistic in regards to like just across the US, who is going to be deploying good money as compared to before. Rates will start to go down. And if you're in a scenario where the product might be expensive now, even though the refinancing fees XYZ might be worse, at the end of the day, if your business is growing, that should drive your net interest rate down over time, right? Which should unlock additional available credit, which should bring your overall payment down, right? So those are kind of the levers. But yes, it's a tough one for sure.
Okay, thank you. That's very interesting.
Yep.
Hey, Daniel, I had added a question to the chat. We're a pre-revenue company and we're looking to fund our first inventory set. What are our options, right? If loans, we need like 5K a month in revenue for loans, like what are our options in this scenario?
So, well, for the first question is there a way that you can start selling, like, can you start driving revenue without necessarily the product? Like, can you start to build that pipeline of demand, right? Whether that's pre-sales or some of the other, that's more so on the non-debt side of things. That's my opinion, right? It's the sooner you can start to do that, the better. If you were going down the inventory route, sort of at an earlier stage, right? There are a couple players who potentially would do it. What I would say though is that it's harder, right? And the likelihood of you getting asked for a personal guarantee in the early days is much higher, right? And so that's just something that I would potentially consider, right? When you are, in your earlier days and applying and starting to think about, how to potentially fund some of that inventory. And the other thing I would say is that there are a few CDFIs, which are community development financial institutions, that are starting to do startup loans, right? Where it's early days and they're willing to, it really ranges in terms of size, but usually it's sub 100K. And but what I would say still, just a caveat, is that often they're going to ask the question of, can you give a personal guarantee and what is your personal credit score in the early days like that? So that's just the my honest early day opinion is and at a certain point in the theme of driving revenue before, like you don't have to, in my opinion, you do not have to crowdfund in order to pre-sell products, right? And so at least getting that first sample made so that you can take some photos, and at least, and if delivery times are delayed, show that revenue, get your first points on the board as fast as possible. Because I also think, from my perspective, personal guarantees in the early days when you haven't necessarily proven out the ROI and the selling of the product isn't necessarily worthwhile doing. But again, it really depends on your own personal financial situation.
So what I'm hearing is, avoiding the personal guarantee route, or, if at all possible, by trying to do some pre-sales or some revenue before the actual product's there. Okay.
Exactly. And by the way, that'll help validate with any lender you'll have a conversation with that there's demand, right? And you've started proving that out, right? And so like that, those are absolutely worth the, yeah. So that's how I've been thinking about it.
Awesome. Thank you.
No problem.
So it's Becky. I messaged you about C2FO. I have another quick question for you. So
Hit me.
yeah, I'm the opposite of what somebody else said, that they are very comfortable with debt and whatnot. I'm literally the opposite, which is not a good thing. I'm learning.
No. By the way, that's a normal thing. Like, there's a reason why there's a giant stigma around debt in America, like student debt crisis. Like, there's a lot of reasons. I get it. Yeah.
Yeah. So now I'm at the point now where I can't bootstrap anymore. I can't ask anyone else for money because it's a good thing. We're about to launch into CVS and over 3,000
Huge.
stores. Yeah. And we're in Walmart. So awesome. But like, I cannot fund the inventory on my own anymore. I just can't. But my process for creating our products takes at least 9 weeks at a minimum.
Yep.
And those POs don't come in until like a month ahead if I'm lucky, as I'm begging. So I'm just trying to figure out, are there products, and I want to take this offline with you too. I'll get your contact and reach out, but like, are there products available? Because like last time I literally was like, all right, I guess I'm taking out some credit cards and like, what am I doing?
No. Okay. So
yeah.
Guys, so for everyone, that is exactly why we exist. That exact scenario there, like to a T, because right, like setting up that debt stack and that flywheel so that you can fund your inventory, right, and deal with your POs on the other side, like is the only, because and then because the reality that and I'm sure you found this with Walmart, I think you mentioned, it's not just about getting it on the shelves. You've got to activate around it. Right. We spoke to Target the other day and they were like, great. Yeah, we expect brands to spend $400,000 to be successful in just advertising.
Yeah. In the
Once they're on our
CVS deck
shelves.
we put together, it was like, how much are you funding in marketing? And our salesperson was like, I was like, I don't know, like a couple $100,000. Our salesperson was like, per SKU? Is that what you're saying? I was like, yes, of course. So yeah.
So let's definitely talk offline because we that's our bread and butter. We can do that all day. Like that's exactly what we do. Bring together the different lenders, make sure those products work well together, make sure that you can go actually feel confident scaling into retail. We can help with that.
Perfect.
Well, that brings us to the top of the hour. Thank you so much again, Daniel, for sharing your wisdom. It was a great conversation. Thank you everyone for joining. We will be following up with a recording of the video in addition to his contact information and an opportunity for you to schedule a meeting with him directly. Until next time, this was actually our last event of 2023. So we hope to see you all again next year and have a wonderful holiday.
Thanks everyone. Appreciate you hopping on.